Okay, thank you. Thank you for your introduction, and many thanks to the rest of the organization, especially to Alba and Andres, for the kind invitation to participate in this edition of the Digital Economy, Technology, and Inequality Summer School hosted by the Faculty of Law of the University of Valencia. Few sectors in the economy present more complexity when it comes to antitrust than the financial sector. In this sense, the main challenges the antitrust law has to face are two. The first one is that the financial sector is characterized by a high degree of necessary collaboration, which frequently involves information exchanges among competitors, and these information exchanges are particularly problematic in situations like syndicated loans, co-insurance, risk pooling, or institutional investors with ownership interests in competing firms. The second one is relative to the fast technological change, which can give rise to antitrust issues associated with disruptive technologies, for instance, exclusionary effects or abuse of a dominant position. Well, in this slide, you can see the three topics I'm going to talk about in this presentation: antitrust law and financial services, the latest issues, fintech, and some solutions. I think it could be helpful. Well, okay, perfect. First of all, I would like to clarify that from the European point of view, it could be said that the competition policy evolves in close relationship with the development of the European common market. For this reason, the primary goals of the European competition law have also been modified in the last years. Up to the 90s, the main purpose of the European competition policy was to support efforts of market integration. Once that step was more or less concluded, the Commission and the courts seemed to be more willing to embrace the Chicago and post-Chicago insights, which only focus on economic aspects of market efficiency. For its part, the financial sector is characterized by a high degree of necessary and pro-competitive collaboration. And this particular need often involves information exchanges among competitors about price, general conditions, capital requirements, market rules, and protocols. Because of that, at the very beginning, the Commission's antitrust enforcement in the financial services sector remained fairly limited. From the late 90s, the Commission's antitrust enforcement activities were mainly focused on payment services providers, including Visa or MasterCard. However, the activity in the financial sector remained rarely controlled by the competition authorities. From the 2011 to date, as a result of the international financial crisis we have been suffering over the last decade, nowadays financial services are seen as a key cornerstone of the European Commission's agenda. Especially in the banking industry, there has been a strong recent focus on enforcement activity by European competition authorities. In this sense, one conclusion from the most recent enforcement actions that have been observed is that antitrust risks are closely related to information exchanges between competitors and that they take place in an increasing number of contests. Having said that, now I would like to highlight two cases that have caught the attention of the European competition authorities in the recent years. Well, in January 2019, the European Commission brought charges against 8 banks for operating a cartel in trading Eurozone government bonds. The European Commission had concerns that at different periods during more than 5 years, the 8 banks participated in a collusive scheme that aimed at distorting competition when trading European government bonds. Firstly, let me explain what European government bonds are. European government bonds are debt securities issued in euro by the central governments of the Eurozone member states. The governments issue this kind of bonds to raise funds in international financial markets. They borrow money for a fixed term and a predefined interest rate. The bondholder periodically receives the interest, the coupon, and the principal amount at the agreed maturity date. Bonds are first issued on the primary market, where a limited number of investment banks, the so-called primary dealers, can buy for the bonds in actions or sometimes acquire them via syndication. The primary dealers then take place and trade the bonds with other investors on the secondary market. These investors include other banks, asset managers, pension funds, hedge funds, and major companies. They can hold the bonds as investments or further trade them via brokers like any other financial instrument, brokers and other traders employed by the banks. Well, the problem detected in this cartel was that at the same time, these traders were in regular contact with each other, mainly in multilateral chat rooms on Bloomberg, especially on Bloomberg terminals, where the relevant traders exchanged commercially sensitive information. They informed and updated each other on the prices and volumes offered in the run-up of the actions and the prices shown on the customers or to the market in general. They discussed and provided each other with recurring updates on their buying strategy and the run-up to the auctions of the Eurozone member states when issuing euro-denominated bonds on the primary market and on trading parameters on the secondary market. Let me show you. Okay, perfect. As finally said by the European Commission, the behavior of these 7 banks violated EU rules that prohibit anti-competitive business practices such as collusion on prices and conditions. Now, in this slide, you can see the different fines that have been set by the European Commission. And, well, NatWest had immunity from fines because he revealed the cartel, and well, you can see there. In my opinion, there are not many. There are not many. There are not quantities very high. Some of them, well, they find the cap to 10% of turnover. The first one, the Bank of America, was turned out because it was outside limitation period. Well, the investigation process was not fairly and was not really, didn't work really well. Something that happens a lot of time in competition issues. Well, the other case I wanted to talk about is the foreign exchange spot trading cartel. In May 2019, the European Commission fined 5 banks for taking part in 2 cartels in the spot foreign exchange market for 11 currencies, such as euro, British pound, or New Zealand or Australian dollars. Foreign exchange, or forex, refers to the trading of currencies. When companies exchange large amounts of a certain currency against another, they usually do so through a forex trader. In this context, the Commission's investigation revealed that some individual traders in charge of forex spot trading on behalf of the relevant banks involved, exchanges sensitive information and trading plans, and occasionally coordinated their trading strategies through various online professional chat rooms. The sensitive information exchanged in these chat rooms was related to the following data: outstanding customers' orders, bid-ask spreads, in other words, prices, they open risk positions, and other details, current or planned trading activities. Following the tacit understanding reached by the participating traders, the information exchanges enabled them to make informed market decisions on whether to sell or buy the currencies they had in their portfolios and when. Once these findings were confirmed, the Commission's investigation revealed that the existence of 2 separate infringements concerning foreign exchange spot trading. The first decision, so-called Forex three-way banana split cartel, imposed a total fine of more than 800 million euros on Barclays, the Royal Bank of Scotland, Citigroup, and JP Morgan. The second decision, the Forex Excess Express cartel, imposed a total fine of almost 300 million euros on Barclays, the Royal Bank of Scotland, and MUFG Bank. UBS was addressed for both decisions, but was not fined as it revealed the existence of these cartels to the Commission. He was the claimant. For its part, the Spanish Competition Authority is facing another challenges relative to the financial sector at the national level. In December 2020, the CNMC initiated disciplinary proceedings against DKV Seguros and Reaseguros for potential antitrust practices. Specifically, the company was alleged to have unilaterally removed the temporary disability coverage from the policies of self-employed policyholders while the state of alarm was in effect, citing the disappearance of the subject matter without saying removal being allowed by the applicable law, namely Ley del Contrato del Seguro. This conduct materialized when the company sent a letter to some of these policyholders, informing them of said avoidance and need to accept this third person to the applicable law. If they did not, the entire policy would be nullified. The National Competition Authority knew about such practice after assessing certain information received through a special inbox created during the lockdown to provide a contact point aimed at gathering all complaints and queries related to the application of competition rules during the pandemic. After its analysis, the National Competition Authority concluded that the insurance company actions were not keeping with the good faith required for companies. All of this could constitute an act of unfair competition penalized in Article 3 of the Antitrust Law and could affect the general interest by distorting competition in the market and alerting the economic behavior of those affected clients who accepted the modifications to their disability leave policy. This proceeding is still ongoing. Well, the second one is the investigation of the eco credit lines cartel. A couple of weeks ago, the National Authority of Competition in Spain opened a sanctioning proceeding against Banco Sabadell, Banco Santander, CaixaBank, and Bankia for possible anti-competitive practices in the marketing of eco-COVID line credit. These guarantees were provided to the Ministry of Economic Affairs and Digital Transformation in 2020 to facilitate access to credit and liquidity for companies and the freelance workers to address the economic and social impact of COVID-19. In particular, the National Competition Authority tries to investigate the linkage to different products that banks have allegedly required as a condition for customers to access these lines. Following the analysis carried out, the CNMC considers that the actions of the banks under investigation differ from the good faith required of companies in their relations with customers. As a result, the practices could have altered the economic behavior of consumers who turn to these institutions to take out eco loans. And all the aforementioned could have distorted free competition and affected the public interest. This proceeding is, as well as the last one, still going on. Let's move to the other topic I introduced at the beginning of this presentation, the new fintech era. There is no doubt the fast technological change is performing new business models, especially in the financial services. The changes of understanding the business, which itself can give rise to antitrust issues associated with disruptive technologies, such as exclusionary effects or abuse of a dominant position. In this slide, you can see 4 topics relative to the fintech revolution. I think they can be the most problematic changes from the antitrust point of view. Will blockchain facilitate collusion? Well, trade finance, payment services, and syndicated loans have already started to embrace blockchain due to its speed, security, and transparency. But the spread of blockchain technologies has also drawn the attention of competition authorities, who question whether this new structure could facilitate collusion. But what's the problem? Blockchain's structure may allow for more sophisticated implementation of an agreement to collude, allowing for easier detection from the agreement and a more accurate retaliation method. Blockchain also enhances transparency, which could prompt competition authorities to more readily bring allegations of tacit collusion. In this regard, whereas explicit collusion constitutes a biocheth infringement, companies cannot be prevented from adapting to the existing and anticipated conduct of the competitors as long as they do not clearly collude. Tacit collusion scenarios are less clear and common and need to be assessed more rigorously under an effect-based assessment. And this will be a great challenge that different competition authorities will have to deal with in the fintech era. Well, big data. Big data applied to financial sector is as well another big challenge the competition authorities will have to face in the near future, especially those problems relative to exclusionary effects and market power. This is very clear in the insurance sector. Collecting data referred to the average level of risk of each risk assumed by insurance companies is the core activity in this industry. The better and more accurate risk data is collected, the better insurance market will perform. Consequently, as big data processes facilitate data collection, this new technology can improve the efficiency of the market. However, the risk of exclusionary effect seems to be high mainly because big data increases market power, and this fact could enable anti-competitive price discrimination practices to arise. And how about merger control? Well, for competition authorities, substantive merger analysis in the fintech sector can be complex since a traditional analysis of market shares and market definition can fail to capture the reality of fintech market dynamics. For instance, fintech mergers are data intensive and the combination of data sets through mergers could give incumbents a competitive advantage which is not reflected in the market shares. Additionally, as a fintech target companies are often startups with either zero or very long turnover, they can escape merger control in turnover rates. The last topic is my favorite one. It says regulatory sandboxes. Regulatory sandboxes are one of the newest and most exciting developments in the world financial regulation. However, they also entail serious problems not only from the point of view of sector regulation, but from the antitrust law perspective. Financial agencies develop these sandboxes to lower regulatory barriers that prevent firms from bringing innovative and new financial products to the market while still protecting consumers through increased oversight and disclosure. As the pace of innovation quickens in financial services, these sandboxes are a way for policymakers to promote innovation while still maintaining a sort of regulatory protection. Sandboxes could become a form of legal privilege that benefits firms admitted into this space, the sandbox, at the expense of their non-admitted competitors. And this would threaten to harm not only non-privileged companies, but financial consumers as well. In a competitive market, an advantage given to one firm by a regulator often serves as a disadvantage for that firm's competitors. If one firm has advantages to test a product with mitigated administrative requirements and fast-track approval, this can cause harm to its competitors, which likely still have to spend their time, their money, and their effort to obtain a license through the traditional process. On the contrary, the sponsored company can now spend those resources on the research on marketing while the competition is still trying to enter the market. Not only does this seem intuitively unjust, but it distorts the market with the positive effect brought by competition, what is called the sandbox paradox. In order for a sandbox to be worth entering, it must convey some benefit to the admitted firms. However, its benefit granted to these firms has the potential to harm market competition. In this sense, the risk of economic privilege is a potential problem that will need to be addressed. But what policymakers can do to soften this risk? Well, in my opinion, I think there are some principles that have to be taken into account by the legislator. For example, legislators should maximize the number of firms allowed to participate in the sandbox. Of course, sandboxes should have requirements for entry, but those criteria should be explicit and objective. Any firm which meets them should be allowed to participate. The aim is to minimize the regulatory discretion about which firms participate in the sandbox, not a legal mechanism to exclude some of the operators. The contrary would be senseless. In order to minimize any risk of anti-competitive advantage, it's important to make regulators be very transparent about what they, as a public institution, and the companies as private participants experience in the sandbox contest. This doesn't mean that confidential information must be disclosed, no. On the contrary, I mean that allowing as many firms to participate as possible and sharing the lessons learned more broadly will help to solve the sandbox paradox and to maximize the benefits of this new and exotic regulatory environment. By now, at least 30 countries have implemented regulatory sandboxes in the world. Asia holds many of these new legal systems, while in Europe, only 5 or 6 countries have implemented this exotic regulation, among others, Spain. Well, Anya's going to finish now, so some solutions. Well, I think that if we take into account competition law in financial sector, we have to highlight these three topics. No, a larger budget for the competition authorities. There are not many resources, especially human resources, in the competition authorities to fight against the cartels and other distortion competition. A more effective regulation, and booster antitrust compliance programs. For example, focusing on restrictions by object prevention, or mechanism to report suspicious operations, special training for agents and brokers, especially in the financial sector. Well, that was all. Thank you so much for inviting me to participate in this spectacular summer school. And hope next time I will be next to you there in Valencia. You have the floor, the electronic floor. Thank you.
Many thanks, Maria. I would like to ask you about what you think about the possibilities of digital tools and digital instruments used by antitrust institutions. So, for instance, the Spanish authority for competition, in order to try to track those activities, those antitrust activities that FinTech may produce. But that's my question. But before I leave you the floor to answer it, I would like also to ask if there's someone else here or online who wants to ask you anything. No, it seems not. So if not, please, you can answer me, and then we will pass to the next presentation. Many thanks, Maria.
Thank you, Andres. Well, I think that the main problem in the authorities, the competition authorities, at a national level or a regional level, is that the budget is really low. There are no resources, personal resources. They have not digital tools, I think. Well, I think that I have heard about the National Competition Authority, the Comisión Nacional de Defensa de la Competencia. I think that they have implemented a new program focusing on big data analytics to control the market, the prices. But I think that the problem is the budget. It's money. It's only money, and it's a pity that they have no money and no persons and no staff. There is no staff enough to fight against the cartels and to investigate properly. I think I think this is the main problem here in Spain. The means, the resources for the competition authorities at the national and a regional level. I think that.
So many thanks. No, but I think that's the key in the future. That is going to be the key in the future, because if we want to try to stop or at least to control these possible risk pooling structures that FinTech or the new insurance model may create, it would be really important to have the instruments, to have the tool to track them. Because if
the
not,
machine against the machine.
Exactly.
You can combat with human persons, technological problems. It's impossible for a staff of 2,000 people controlling the market. It's absolutely impossible to fight the digital market, to have the digital tools to fight the market. And this is only budgetary, it's only money, I think.